economic shock in less than 20 years. House prices have decoupled from incomes over 400%. We'll limit negative gearing for residential property to new builds from July next year, replacing the 50% capital gains tax discount with inflation-adjusted indexation.
Those that were just buying and holding and set and forget, it's game over. So it is the death of your lazy investor, your mum and dad investor that just buy, hold and hope.
Lachlan's been a big week in our world and Australia in general post-budget.
This has been the most significant shift to our landscape. And if you're not pivoting, then you are going to get left behind.
Is it the death of the mum and dad investor who was hitting and hoping?
Without a doubt, things just got a whole lot more complicated and the gap between the rich and the poor just got greater.
Two major changes that the government proposed last week was negative gearing and CGT.
Most significant political change in the property market since 1985. They do want to understand the data and that's our job.
Do you think history is going to repeat itself here in Australia? Rents will rise 20-30% in the next 2 years.
My prediction, we're going to see...
You're listening to the Folio Property Podcast. I'm Reece Beddall. I'm here each week with my co-host Lachlan Delahunty. Okay, Lachlan, big episode today off the back of the budget week last week. We were addressing a lot from, the government and the policy perspective and where we see that going in Australia in 2026. We've also touched on some live examples from a CGT perspective as well that you've recently seen with your clients.
Yeah, but I'm going to go through exactly what this means for the Australian property market and where I see the opportunity, Reece, and I think that's really important. So much noise. I don't think I've seen the property segment as a whole get so much attention than it has in the last week off the back of the budget.
Hey guys, quick thing to share. If you're serious about investing in Australian property right now, you need to see what we put together. It's called the National Investment Report, and it's our brand new monthly deep dive into exactly where the market is moving, what the data is saying, and what the smart investors are looking at right now. You can get the first access completely free. Just scan the QR code on the screen right now or click in the link below to fill out the form. I think we've addressed the budget over the last couple of weeks, and I think today's now, okay, let's talk about what we think is going to happen to the property market off the back of the budget. We've been getting some feedback on some recent episodes where people want to stick to the strategies, they don't like the political take. I mean, the big thing is it's been a big change in the industry. So
it's been the biggest change in our industry, at least in the last decade, if not much longer than that. So I understand people like, we're not a political podcast and we will not ever try to be one. But you've got to understand this has been the most significant shift to our landscape. And if you want strategies advice and you want strategy podcast, I can't give you a strategy unless I understand the landscape that we're playing in, because the strategy now, Reece, is extremely different to what the strategy was 2 weeks ago. And if you're not pivoting, then you are going to get left behind by the pack of what will now need to be sophisticated investors. Those that were just buying and holding and set and forget, it's game over.
Is it the death of the mum and dad investor who was hitting and hoping?
Without a doubt. This will be the hardest period moving forward to A, understand the market, but B, get ahead in real estate in Australia. Like, do not underestimate how significant this is. And I'm not talking what it means for the markets. We're going to cover that today, right? Today we're covering what does this mean for Australian markets, what will happen, and I'm going to talk through that. But you as an individual investor, things just got a whole lot more complicated and the gap between the rich and the poor just got greater. So it is... yeah, the death of your lazy investor, your mum and dad investor that just buy, hold and hope. It's game over.
There's plenty of opportunities out there and we'll be getting back to our roots in the next couple of episodes with some strategies. But as we said today, let's see what has happened previously when we've had changes like this in Australia or New Zealand as a case study. And let's go through where you predict sort of, what's going to happen to the property market moving forward in 2026.
It is, and people want answers, and I know it's, when we went live with this episode Tuesday when it was launched, like I was on the fence whether we should do that episode because I said to you, Reece, I need to understand this, and I need typically days, if not months, if not at least weeks to digest the information, to research and understand what it fully means before I give advice. And the same, history repeats itself. The same thing happened when COVID hit, although a different example. It's a significant change to our industry. So you need to understand it, and then we need time to research it, digest it, to then be able to provide informed advice based on data. That's all it is. No one wants to hear my opinion. I don't think anyone cares about your or my opinion about things, Reece. Political or analytical, But they do want to understand the data, and that's our job, I believe, as a property podcast, is not talk through my biases, it's talk through data. And that's what we've done. We're going back in history, we've gone back to periods in time to look at what actually happens when significant political change takes place in the Australian market.
Let's talk through negative gearing, as this was the two major changes that the government proposed last week was negative gearing and CGT. I thought we'd touch on negative gearing, where we can look at an example from New Zealand, what happened to the market there and the feedback, I guess, from people over there, and then also look at back to 1985, where the government subsequently removed negative gearing, but then reinstated it sort of 26 months later as well.
100%. But before we dive in there, let's go back a bit further, or let's go back to our most recent example in Australia with COVID. What happened during that period? And that's what I sort of want to... When significant change happens, and this happened sort of the weeks post-COVID, and why I talk about this is because there's so much noise out there. So you read in the paper every day, market's going to fall. What does this mean? It means business is going to fail. Why would you invest in Australia? It's not good for startups. Retirees, what are they going to do? Markets could plummet. One banker's indicating that Sydney could fall by 20, 30, even 40%. So all these headlines, same thing with COVID. Let's just have a little bit of a take back to some of the headlines there, where markets were going to fall 30% year one, 40% year two, 70% got decline in the property market. At that point in time, Reece, I had to take a view. We as a business had to make a decision as to what it meant for our clients. And that's the most important thing when change like this happens. So what did we do? Told our clients to do nothing. Give us 4 weeks to understand what this means for you, and we'll come back to you with an informed outlook on what we think may or may not happen with the information that we had. And so what did we do? We went back in time and looked at all the major financial crises, dot-com crash, obviously the recent GFC crash prior to that, and right back to the recession times, early 1900s. What actually happens when there is significant financial change in the markets? And what was interesting was, if you went into the detail and the data, it was the opposite of what all these major banks, these credible economists had actually predicted, which was quite strange. And so you have to dig a bit deeper. You go, I must be wrong. The data that we're analysing must be wrong, because surely our major banks couldn't get this so wrong. But what we found, Reece, was that change occurs in the marketplaces. We've seen the share market drop by 40% in a very short succession. But then you start to see how the government plays their hand. And at the time, they just throw money at it. They want to keep the economy afloat. So government spending, all of a sudden we had JobKeeper and all these things start to get announced. Interest rates start to come off. And instead of prices contracting, prices actually go on a run. And history tells us through those periods of time that prices didn't actually go down, they actually went up post these significant events. So then we come out to our client base with a statement saying, do not sell. If you do sell, you'll be selling at a discount, because anyone that needs to sell in this environment, this is the weeks post-COVID, when everyone thought the world potentially could end. So it was, we had to be real with it. Don't sell because we think you'll be selling at a discount. Banks will support you. They've already indicated that if you can't make your repayments because of loss of job or work, that they'll put your interest on pause. So this is fantastic. Come see us before you do anything, particularly if you're going to sell. We're big on people not panicking selling, and had to make the boldest statement that for an opportunist investor, and everyone can say, well, you're a business that buys property, of course it's always a good time to buy. No, but data told us that actually this could end up with positive market conditions. So if you are in a position where your job is safe and it allows you to do so, you could consider taking a hedge in this period of time and getting something at a serious discount, which history would tell us the prices would rise. So why I speak about that, and you're like, well, that was 6 years ago, I could just be making this up. That's what we did, speak to our clients, and I can probably send out the letter that we actually addressed all our clients with, that, stating that exact fact. Why is that important? A, because clients didn't make a bad mistake, but B, we're in the same situation right now. It's just you're looking through a different lens. It's not a GFC, it's not a financial crisis, but it's serious, most significant political change in the property market since 1985. So this is huge. So that's why we have to talk about it. We're not a political podcast, but we are a property podcast, and this is the biggest thing to happen to us since 1985. So with that, I've gone back, Reece, gone back in time and gone to New Zealand as a more recent reference point to find out what happens to property prices and rents and the general market when there is significant political change. So where did you want to start?
Let's start with New Zealand. Exactly what you said there. So 2021, removal of negative gearing, reversed in 2023. During that period, rents increased up to 30% across New Zealand. So That's one thing I want you to ponder with. The other is not too dissimilar from today's environment. It was starting to go to a rate increasing environment as well.
Yeah, and the difference when we go back in time and look at New Zealand, Australia across the board is in an undersupplied scenario, right? We've got vacancy rates at almost all-time lows, and particularly in some sub-markets, Brisbane, Adelaide and Perth, significant undersupply. So New Zealand, 21 to 23, that policy of negative gearing was removed. Rents risen so significantly, put so much pressure on the rental market, and we saw double-digit growth year on year that they had to retract it. Interesting.
Up to 30%.
Yeah, 30% rise in rental prices. And understanding that this policy was introduced to sort of protect somewhat that demographic, and not going to go down a political path, but what does it mean for property prices on that example? Well, investors may retract a bit from the market, which would mean, potentially less investment properties available. Therefore, rents would increase significantly, which may in some cases offset the negative gearing component that you would receive anyway.
Let's go through the Australian example, which a lot of listeners might not necessarily relate to because they're probably not of an age of being affected by this, but from an Australian political standpoint can have a bit more of a closer understanding of what's just recently happened in the last 7 days. In 1985, it's been publicised all throughout the weeks leading up to it, the Hawke-Keating government removed negative gearing. They reversed that in 26 months' time, similar to the same reason.
2 years later, reversed it. Okay. Why is that?
Exact same thing. So capital cities rents increased up to 30% during that period.
Again, 30% increase in rents is significant. And this double-digit rents is significant, 10%, right? This is 15% year on year over a 2 year period. Rents skyrocket by 30% in both New Zealand and Australia in a 2 year window.
Correct. And I think the interesting thing here, which again, we're not going down the political route, but it is matter of fact of what's probably happened here in Australia over the last 6 months, is a lot of these first-time buyers are either in these over-leveraged positions from the 95% no LMI scheme at the back end of last year, or they're in rentals trying to save that deposit to get into the market. So if rents are going to increase by the significant amount that they did back in 85, back in 2021 in New Zealand, feels like it's only going to put pressure on those first-time buyers again.
Yeah, correct. But from an investment standpoint, what's really positive here as an investor, not as a tenant, is that rents are going to rise. So if I've got interest in investment property, I guess those that bought up prior to budget night get a double kicker. If there is any negative gearing, you're probably only going to get a benefit for a short period because rents are going to rise at the point where you may be able to service that home with a positive income stream coming in rather than a negative to offset it. So if rents rise, it becomes a more of an attractive place, again, to invest, being that shares and businesses now get the same capital gains treatment as property. That argument versus shares versus property with your dividend, be that the rental return increases by 30% over the next 2 years, becomes really attractive.
With your your advisor hat on here, Lachlan, like if you're looking at those figures there, both examples showing up to 30% in the last 2 years, if someone is purchasing investment property from now on, should they be looking at modelling out some sort of scenarios where there is going to be that rental increase from a yield position?
Yeah, if you're not doing modelling prior to budget night, you should not be looking at investment property without doing forecasting and modelling on cash flow and tax outcome. Like it's your post-tax return on investment now just become more important than it ever has. And like I said in our previous podcast, Reece, things just got a whole lot more complicated. The average mum and dad that just try to buy a property with little knowledge, but with luck on their side or market movements on their side, have done really well, sort of accidentally. Those days are gone. Like if you're not modelling, understanding, you're talking hundreds of thousands of dollars in difference in terms of your net outcome by not doing your homework and understanding the asset and the cash flow and the tax outcome of the property and or asset that you're buying.
Speaking of that, I guess the elephant in the room we haven't addressed on the negative gearing front is it is exempt to new builds.
Okay.
We've had a lot of questions come through the podcast over the last week. We've even had people come in through our business as well asking questions around that strategy, and we've been very vocal about our concerns of those outer suburb fringe areas from a house and land package perspective. What do you see that the 2026 looking like for those markets? Are we going to be inundated with investors flooding to these, and is that a high risk, do you see?
Certainly, and we're going to see an influx of spruikers in that market to essentially the government's just given them free advertising to think it's a good idea. I think this would be a negative outcome for any investor looking to go into those markets, because what people will fail to understand is on the headline or on that sales pitch that you've clicked on Instagram is that these returns, these promising returns, these guarantees that you can do so still in a 50% tax-free environment through the 50% with the CGT discount. But in reality, Reece, you're buying into a market that's under-resourced with infrastructure already, and you're buying into a market which will be flooded likely by north of 80% investment property. So again, creating ghettos where there will be a higher vacancy rate. So nationally, I think we'll see vacancy rates lower, particularly in more inner city, more desirable locations, and you'll see vacancy rates due to oversupply in these outer fringes go up significantly. So vacancy rates mean property won't be rented. But then who's going to buy that product? Because the next investor doesn't get any of the benefits. And this is what people fail to see. So if they sell that property, they're selling it as an established property. So the next buyer's not going to touch it as an investment because you don't get negative gearing or capital gains benefit. So there's no buyer. And when you invest in real estate, all you think about, or if you're not, all you should be thinking about is what is my exit and who am I selling to? What's my demographic? And if you in these areas where 90% of the purchasers are investors, and you can't sell to that demographic, you're trying to appeal to the 10% against a flood of oversupply house and land packages, of which they're building out, further from you that are cheaper or more desirable locations. And so, we can't echo enough the reasons not to invest in those outer fringes, because you just got to understand what you're getting.
Like that is the number one point you just said there. I think clip that up, everyone who's thinking of a new build investment purchase, because that's the biggest one there, right?
Yeah.
It only counts for the person purchasing that property. After that, you lose all advantage of claiming the negative gearing. So,
but we're going to talk more strategy next week, or where we see the opportunity, and there is some opportunity within the sort of infill development space. So that new build development, small style development, not just in your individual capacity, but potentially small format syndications become a really good idea, Reece. But we're going to touch more on that next week as we go into more strategies, how to capitalise post-budget. But let's just get back to what we were talking about. What does this mean for the Australian property market in terms of the outcome last week?
And off the back of the negative gearing, when it got reinstated, some core stats here as property prices surged once they've been reinstated. We saw Sydney up to 60%, Brisbane up to 60%, Perth rose up to 100%.
So the 5 years post the introduction and then the removal of negative gearing, what we saw, rents rise up to 50, 60%. We've seen property prices rise 70% nationally. So this is our really only localised Australian example of when negative gearing was removed. So it's an interesting call to say property prices and rents are going to contract, when our most recent example from 1985, the exact opposite happened, and happened in double-digit territory, both with property house prices as well as rents.
And I mean, looking at both these examples, there was a 2-year period, funnily enough, on both of them. With your crystal ball here, do you think history is going to repeat itself here in Australia? Rents will rise 20-30% in the next 2 years, and the government will look to not necessarily reform, but review the current policy. Yeah,
I think this will be extremely short-lived. We only have to look at the only examples that it was introduced, it's been eradicated within 2 years. We've seen how the market and how Australia has responded to this, banded together. I haven't really spoken or seen anyone who's come away saying that was a good budget, and you can already see in the lobbying against this policy. So a lot has to happen for it to get passed through. We know that. So there's absolutely no guarantee that this is the new lay of the land. But if it is, what does it mean? It isn't doom and gloom. It's actually the opposite. We could see a significant uplift in rents, which from property investors' standpoint is a good thing. And history tells us that prices typically go on a run post these sort of policy changes. So come back to you. So my outlook, rents are going to run hard and extremely hard for the next 18 months, which is going to put so much pressure on a government that's already in the spotlight, right? This all leans into the 2020. This will all lead up to the 2028 election, of which there's going to be a lot of promises and a lot of talks around these two big items, capital gains and negative gearing. So my prediction, we're going to see rents soar, a change in policy at some point, and off the back of that change in policy, prices will also soar and quite significantly. And that's sort of the game plan that took place in the mid-'80s, right? Rents rose, they removed negative gearing, and prices continued to run well north of double-digit growth. So that's the game plan. So what does that mean for the next 2 years? Well, we're going to talk about it a bit more in the next episode. There's going to be opportunities in the market to maximise the hand we've been dealt. And that strategy, like I keep saying, is a lot different to what it was 2 weeks ago.
Let's talk about CGT. So that was the big change off the back of the budget. So we've touched on kind of negative gearing, what that looked like from a example back in 85 in Australia, and then also the New Zealand example. But let's talk CGT. How big of an impact do you see that having in the market from a sentiment perspective from a property investor?
It definitely will, and already has had some level of impact. But I think it's overstated the net outcome of these changes. In highly inflationary environments, which we're in, your tax outcome actually will likely be better. Where inflation is at the moment, your tax outcome is better than what it is under the old policy. In normal environments, what do you say normal? Between that 2 and 3%, you are slightly worse off, correct, but forecasting over the next 5 years, Reece, I'd say we're going to be somewhere between 2.5% and 3.5%, which means your net tax outcome under the indexation methodology won't be dramatically different. And we've got a live example, Reece, of some clients that we went through that bought and sold in Western Australia and compared their tax outcome under the old method as well as under the new indexation method. And let's just go through those figures.
Okay, Lachlan, let's talk through CGT. Specifically with the new changes and looking at example property.
Yeah, interesting, Reece. So obviously the capital gains, we talked about it, high inflationary environment, you actually turn up. So the example that we looked at, Reece, going through and just looking at what does this mean for our clients, had a client bought in 2017, sold late last year, and I netted out their tax outcome. And what was interesting, there's only a $42,000 difference between what they paid in tax and what they would under the new indexation method, right? So that's about $5,000 more per year they paid in tax under the new methodology. So, yeah, not ideal. We certainly don't want to be paying more tax, but their gain was significant. We're talking, so when you're looking at it in that scenario, it's more than a $700,000 gain and only having a $42,000 difference in tax, you're still not going to be unhappy with that outcome. It still makes property, and we know with property it's the power of leverage, still a very good investment vehicle for wealth generation. So gone through a couple of different examples with different clients at different price points as well, Reece, and consistently they do pay more tax under the indexation model, but it's certainly not as dramatic as what it first appears when you get the pen and paper out on the back of a cereal box. It just looks doom and gloom, but when you actually look at it, and now we're in a very highly inflationary environment and forecasts suggest that we could be potentially for the next decade, you could be in a very similar net tax outcome as what you were before budget night.
And the big thing here, right, this CGT applies to shares, crypto, business owners. So
that's the big one. Business owners is like they're lobbying hard, and I completely agree. It just disincentivises any young entrepreneur, anyone, young business owner to want to set up businesses in Australia. That's the one I think will get lobbied and lobbied hard, and I think they'll be the first to get thrown out.
All right, let's just wrap it up then. So we've spoken through negative gearing, CGT changes, what we think will happen to the market post these changes, where we see that going. Let's talk through just quickly. We won't go through it in detail because that will be for next week's episode, but let's just let the audience know some asset types and locations that we do like. Yep. Post these changes, and some may be different strategies from pre-budget, and some may be just reinforcing the same strategies pre-budget, and then also looking in areas that you wouldn't want to touch.
Yeah, if I look pre-budget versus post-budget, what doesn't change? Location just become more paramount. So we always talk about sort of location does 80% of the heavy lifting. Well, now it probably does 85 to 90%, right? So getting blue chip localities at the right time in the cycle is more paramount than ever. Pre-budget, a lot of the assets that we like to buy with land banking blue chip localities, so large land contents where we were going to get a benefit through negative gearing to hold those assets, that strategy's now past. It's going to be very difficult for people to go and land bank assets in most localities because your cash burn's going to be so significant. So that's what's changed. What hasn't changed, there is nothing out of this budget which would lean for us to say it's a good idea to buy off the plan apartments, house and land packages, medium or high density across the board. That hasn't changed. Where there is some opportunity, we're going to speak about it next week, is in blue chip greenfield development areas where you can create land, so you still get the benefits, but you're going to get more capital growth because these areas become more scarce. So the number of investment properties in infilled locations, so when I say infill, I mean landlocked localities. So you're talking, as a base rule, 5 to 20 Ks of a CBD. Those areas are going to become significantly undersupplied because investors can't land bank in those areas. So rents are going to rise. So if you can contribute to bring on more supply through development, then I think you're going to get an uplift in capital growth. You're going to get a significant uplift in rents, and you're still going to get the same negative gearing and the capital gains discount as you were previously. So I think there's definitely a lot to look at in that space. Commercial's getting thrown up a lot. My concern commercially, people are just going to go, I have to go and buy commercial. Commercial has a space in your portfolio, but certainly, again, commercial assets it's the strength of a commercial asset is the strength of its tenant. There's going to be a flood of these investment groups flogging things sub $1 million. Hairdressing tenants, kickboxing tenants, stay way away from that. There's one thing that's going to absolutely destroy your portfolio is having a strata unit or a strata office or a retail showroom that's vacant for 3 or 4 years. So there will be a place for commercial, but still it sits with a sophisticated investor at a different point. There's other ways we can generate cash flow through residential properties, and that could be through unit block complexes or higher yielding units that serve a purpose in blue chip localities where there's still underlying land value, and that's really important. So there's a lot to cover next week, Reece. We're going to go through all the strategies where I see the best opportunities across Australia, so stay tuned for that.
Anyone got any questions pre-episode, please leave them in the YouTube comments and Spotify. We'll be talking about this next week, but if you've got any questions for us pre-episode, please whack them in. You've been listening to the Folio Property Podcast.